Welcome back to the podcast. I'm Jeff Trapp, helping you stay out of the tax trap. Today's topic is one that surprises almost every successful business owner I meet. Here's the question. Can you have a great CPA and still pay hundreds of thousands of dollars more in taxes than necessary? The answer is absolutely yes. Now, before anyone gets offended, this isn't about bad accountants. In fact, some of the clients we work with come from some of the best CPA firms in the country. The issue isn't intelligence. The issue isn't effort. The issue is understanding the role your CPA has been hired to perform. Most business owners assume that if someone prepares a tax return, they're also minimizing their taxes. Those are actually two completely different jobs. Today, I want to talk you through what I call the 5 levels of tax advice: tax preparation, tax compliance, tax planning, tax strategy, and tax coordination. Understanding these 5 levels may be one of the most valuable financial lessons you'll ever learn. So let's start with the first level, tax preparation. Tax preparation answers one simple question: what do I owe the IRS and the state taxing authorities? Your CPA gathers your documents, prepares the tax returns, makes sure everything is accurate, files it with the IRS. Think of a tax preparer as a historian. They're documenting what already happened. They're looking in the rear view mirror. And there's absolutely nothing wrong with that. In fact, tax preparation is incredibly important. But here's the problem. By the time you're preparing your tax return, the tax year is already over. You know, it's like watching the Super Bowl on Monday morning and trying to change the final score. You just can't do it. So, for example, let's just say a business owner earns $2 million during the year. In February, they send all of their financial statements to their CPA. The CPA prepares the flawless tax return. Everything is accurate. Every deduction they're entitled to has been claimed. They still owe $650,000 in taxes. The return wasn't the problem. The opportunity to save another $200,000 or $300,000 disappeared months earlier because nobody planned ahead. That's tax preparation. It's necessary. It's important. We all have to do it, but it can be reactive. Now, the second level is tax compliance. Compliance answers a different question. Are we following the rules? This includes payroll filings, sales tax requirements, estimated tax payments, entity compliance, information reporting, IRS deadlines. Compliance keeps you out of trouble. It reduces penalties. It keeps the IRS happy, but compliance doesn't necessarily reduce your taxes. It just simply ensures you are following the law. For example, let's say someone purchases a building for $1.5 million. Their CPA depreciates the building correctly. Everything is filed accurately, excellent compliance, but no one discussed doing a cost segregation study. No one evaluated bonus depreciation. No one considered whether the property should have been purchased through a different entity. Everything was compliant. Hundreds of thousands of dollars in tax savings may have been left on the table. Compliance is an optimization. Now let's talk about where things begin to change: tax planning. Now, tax planning asks a completely different question. What should we do before the tax year is over? This is where we begin looking forward instead of backwards. Tax planning includes things like retirement contributions, cost segregation studies, hiring your children, the Augusta rule, equipment purchases, timing income and deductions, entity elections. But here's where I think our profession has created a huge misconception. People think tax planning is something you do once a year. Maybe in November, maybe in December, you sit down for an hour, look at your projected income, implement a few ideas, and call it tax planning. I don't believe that's tax planning. I believe that's year-end tax planning. Real tax planning is a 365-day process. Now, let me explain. People often ask me, why would we need to meet with our clients every quarter? They'll say, Jeff, isn't tax planning just something you do at the end of the year? And I always use football as an example. An NFL team only plays 17 regular season games. That's all the fans see unless they make the playoffs. But nobody would say football is only played on those 17 Sundays. Players spend the entire year preparing. They have off-season workouts, training camp, film study, strength and conditioning, weekly practices, and constantly review game film. They adjust their game plans based upon their next opponent. They're preparing all year long so that when game day arrives, they're in the best possible position to win. Tax planning is exactly the same. Tax season is game day, but the championship isn't won during tax season. It's won through the preparation that happens throughout the entire year. Business owners don't make major financial decisions only in December. They buy buildings in March, hire employees in April, sell businesses in June, purchase equipment in August, expand into new states throughout the year. Every one of those decisions has tax consequences. If your tax advisor isn't involved until November, you probably miss 10 months of opportunities. The best tax decisions are almost always made before the transaction, not after it. Imagine it's October. A business owner expects to earn $1 million this year. Their CPA recommends purchasing equipment before year end to maximize depreciation. That's great advice. Maybe it saves them $150,000. But imagine if that advisor had been involved all year long. Maybe they would have structured a real estate purchase differently, implemented a cost segregation study months earlier, updated an estate plan before acquiring new assets, adjusted income timing, or coordinated additional tax saving opportunities throughout the year. The tax savings don't come from one meeting in December. They come from making better decisions every month of the year. That's what true tax planning looks like. The fourth level is tax strategy. Strategy asks an even bigger question. What should our financial life look like over the next 5 to 10 years? This is where affluent families separate themselves, because wealthy families just don't reduce taxes this year. They build systems that reduce taxes for decades. Strategy includes things like business structure, exit planning, estate planning, trust, real estate, investment selection, asset protection, cash flow, charitable planning, succession planning, and multi-year tax projections. For example, imagine you're planning to sell your business 3 years from now. Tax preparation says, hey, we're going to report the gain when the business sells. Tax planning estimates the tax. Tax strategy says, hey, let's begin planning today. Should ownership be restructured? Should trust be established? Should charitable planning begin now? Should state residency change before the sale? Should investments be coordinated before negotiations even begin? Those decisions often need to happen before the business sells, not after the letter of intent has already been signed. That's tax strategy. Finally, we arrive at what I believe is the highest level, tax coordination. This is the level almost nobody ever talks about. After working with hundreds of affluent families, I've learned something. The biggest tax mistakes rarely happen because people have bad advisors. They happen because they have great advisors who aren't talking to each other. They have a CPA, a financial advisor, an attorney, an insurance professional, an investment advisor, a business consultant. Every one of them is excellent. Every one of them is acting in the client's best interest, but nobody is leading the orchestra. Imagine listening to 5 world-class musicians, each playing a different song. Individually, they're exceptional. Together, it sounds awful. And that's exactly what happens when advisors don't coordinate. Tax coordination isn't an annual meeting. It is an ongoing relationship. Our clients don't wait until December to call us. They call us before buying a building, before hiring family members, before signing a letter of intent, before making a large investment, before moving to another state, before making a major financial decision, because taxes are a result of decisions, not forms. Now imagine if an NFL coach only talked to his team after the season ended. He'd review the statistics, explain every mistake, tell everyone what they should have done differently, then send them home. That's essentially what tax preparation is. It's accurate, it's important, it tells you what happened, but it doesn't change the outcome. Tax planning and tax coordination are like having a coach with you throughout the entire season, reviewing the game plans, making the adjustments, preparing for the next opponent, helping you make better decisions before the next play is even called. That's the difference between reacting to taxes and proactively managing them. So here's what I'd like to leave you with today. Tax preparation is necessary. Tax compliance is essential. Tax planning is valuable. Tax strategy creates long-term wealth. But tax coordination is what brings everything together. Taxes aren't managed during tax season. They're managed through the decisions you make every week of the year. Now, if your CPA only hears from you when it's time to prepare your tax return, or even once a year for a tax planning meeting, there's a good chance opportunities are being missed. The most successful business owners don't think of tax planning as an annual event. They treat it as a year-round advisory relationship where every major financial decision is viewed through a tax lens before it's made. Because the goal isn't simply to pay the correct amount of tax. The goal is to legally pay the lowest amount of tax possible over your lifetime while building lasting wealth. If you found today's episode helpful, I encourage you to share it with another business owner. Chances are they're asking their CPA to do a job that no one professional was ever meant to do alone. I'm Jeff Trapp, helping you stay out of the tax trap. Thanks for listening, and I'll see you next time. Have a great one.